So I want you to picture a highly familiar scenario for a second. Think about a local community group near you.
Right.
It starts out incredibly small, you have a handful of passionate volunteers, maybe a very modest local council grant, and they're holding their strategic planning meetings in the back of I don't know, a drafty church hall.
Oh, yeah. Very grassroots.
Exactly. It's simple. But fast forward 5 years, that same little group has suddenly exploded. They now have like full-time paid staff. They're
Yeah.
pulling in $500,000 in annual revenue across 3 different state and federal funding streams.
It's just fantastic.
It
Yeah.
is. They are doing undeniable, incredible work in your community. And here's the massive catcher, the volunteer board of directors is still trying to run the organizational tax affairs the exact same way they did when the entire operation could literally fit inside a shoebox.
Oh, the shoebox mentality. Yeah,
Yeah.
that is where the time bomb starts ticking, because the moment of reckoning is, well, it's almost inevitable in that growth cycle. A major institutional funder asks for formal, documented evidence of their tax status before they'll release the next round of grant money. Or the Australian Taxation Office, the ATO, sends a please explain letter.
And then panic sets in.
Absolute deafening silence around the board table. These dedicated, hardworking people look at each other and realize they cannot actually prove they are entitled to the tax concessions they've been relying on to, keep the lights on.
That terrifying gap, the space between how a not-for-profit operates on the ground every single day and how it is technically governed for tax purposes, well, that is the entire mission for our deep dive today.
It's a big one.
It really is. We are unpacking a brilliantly detailed briefing from Trinity Accounting Practice. It's titled Tax Compliance Framework for Australian Not-for-Profits. And this is really a reality check for anyone listening right now who sits on a board or volunteers their weekends or works in the sector.
Yeah, the source material makes it very clear that misunderstanding these rules isn't just an administrative oops. We are talking about the potential loss of the fundamental financial structures that allow these organizations to exist at all. Misunderstanding the legal framework is the most common and, frankly, the most dangerous risk they see.
So let's start with the biggest illusion of all, because the brief tackles this immediately. People treat the term not-for-profit like it is some magical force field.
Right, like a shield.
Yeah, you slap NFP on your website and you just assume it acts like diplomatic immunity for community groups. But this brief explicitly states, and this is wild, not-for-profit is not a tax status at all.
No, it's really not. The label not-for-profit is strictly about your organizational purpose and your internal governing rules. It simply means you do not operate for the financial profit of your individual members.
Okay.
To even use the label, your constitution must have a proper non-distribution clause.
Meaning, I can't just start a charity, run it successfully, and then, pocket the surplus cash at the end of the year as a nice little bonus for myself.
Precisely. You cannot distribute profits to the founders or the members. And you also need a winding up clause, which legally dictates that if the organization folds, any remaining assets must be transferred to another organization with a similar purpose.
Ah, so you can't just sell it off and enrich the board.
Exactly.
Right.
But here is the critical part. Having those clauses and calling yourself an NFP grants you absolutely zero tax concessions from the government. None.
Wow. So the label is really just a description of your internal plumbing, not a free pass from the ATO. Which brings up the great divide the source outlines. Not all NFPs live in the same regulatory universe, do they?
They absolutely don't. Every growing organization has to understand the split between charities and non-charity not-for-profits. If you want to be legally recognized as a charity, you cannot just declare yourself one. You have to pass through the gates of the ACNC, the Australian Charities and Not-for-Profits Commission.
Yeah.
Registration with the ACNC is the mandatory, non-negotiable gateway before you can even ask the ATO for charity tax concessions.
But what about the local hobby groups or, the neighborhood sports clubs? They aren't going through the ACNC, are they?
No, they're the non-charitable NFPs. They operate entirely outside the ACNC's jurisdiction. But as we'll get into a bit later, the ATO has recently realized that leaving them unchecked was creating a massive blind spot. And that has fundamentally changed how they have to report their activities.
Let's look at the actual prizes these organizations are trying to win because, nobody subjects themselves to government bureaucracy just for fun.
Definitely not.
The Trinity Accounting Practice brief outlines 4 major concessions, but rather than just listing them off like a textbook, let's look at how a growing group actually encounters them. Say our little church hall group gets its act together and secures the first big win income tax exemption. For charities, they get formal ATO endorsement. For non-charities, they self-assess. But basically, it means they aren't paying corporate tax on their surplus.
Which gives them the breathing room to actually build a reserve. But as they grow, they start buying more equipment, running bigger events, dealing with more complex cash flow. And that triggers the need for the second major operational advantage, which is GST concessions.
Right, the goods and services tax.
Exactly. Ordinarily, a for-profit business has to register for GST the moment their annual turnover hits $75,000. But for an NFP, that mandatory registration threshold is doubled to $150,000.
Which is a lot of extra runway for a volunteer treasurer. I mean, you don't have to deal with the administrative heavy lifting of charging and claiming GST on every little transaction while you're still relatively small.
Yeah, it's a huge relief.
But let's say our group hits $300,000 in revenue. Now they need to hire an actual full-time manager. A charity can't usually offer the massive corporate salaries needed to attract top talent. And this triggers the need for the third concession, right? Fringe benefits tax, or FBT exemptions?
Yeah, FBT is a lifeline for talent acquisition in the sector. Specific types of organizations like public benevolent institutions or health promotion charities, they can access an FBT exemption or a rebate. It allows them to offer salary packaging.
I want to make sure the listener really grasps the mechanics of this because honestly, it sounds like accounting magic. An employee can essentially pay for personal expenses like their rent, their mortgage, or their car out of their pre-tax income.
That is the mechanism, yeah. By paying those expenses pre-tax, the employee's taxable income drops significantly, which artificially boosts their actual take-home pay.
Okay, but doesn't the ATO usually penalize companies for that?
Normally, yes. The ATO would heavily tax the employer for providing those perks. That is exactly what fringe benefits tax is designed to do. The ATO calculates the grossed-up value of the perk, essentially figuring out how much cash income the employee would have needed to earn to buy that perk after tax.
But the concession caps that grossed-up value, right, and makes it exempt from the penalty tax for the charity.
Exactly. So the charity can effectively pay someone a $70,000 salary, but the employee takes home the equivalent of someone earning $90,000 in the corporate sector without costing the charity an extra 20 grand.
Wow. That is exactly the competitive edge they need. But eventually, our growing organization wants to launch, say, a massive public fundraising campaign. And that is when they hit the final and most heavily guarded concession DGR, or deductible gift recipient status. This allows donors to claim a tax deduction on their own personal tax returns for gifts of $2 or more.
Yep, the golden ticket for fundraising.
Okay, but let me pause here because the brief highlights a massive trap. If I'm running a fully registered ACNC-compliant charity, I'd naturally assume I can offer tax deductions to my donors. I mean, I'm a charity, ergo, donations are tax deductible. Right. Assuming that will land you in severe legal trouble. Think of charity registration as getting your standard driver's license. It proves, the basic rules of the road. But DGR status, the ability to give out tax deductions, is like getting a license to drive a hazardous materials truck. A hazmat truck. Yeah, it requires a completely different, much higher level of scrutiny. Because DGR directly costs the government money. Absolutely. When you grant DGR status, the government is essentially agreeing to forego its own tax revenue every time someone donates to you. They are essentially co-funding your charity. So the ATO guards that door fiercely. You can be a wonderful, compliant charity doing great work and absolutely not qualify for DGR. And if you just print it on your flyers anyway.
If you print tax deductible on your flyers without that specific endorsement, you are misleading your donors and facing massive ATO penalties.
That makes total sense when you frame it around the government protecting its own revenue. Which brings us back to the sports clubs and the hobby groups, the non-charities. Because for a long time, they were kind of flying under the radar, weren't they? They didn't have the ACNC watching them, and they weren't necessarily seeking DGR status.
They were operating in the shadows. For decades, many non-charitable NFPs just assumed they were income tax exempt. They never lodged a return and never spoke to the ATO. But behind the scenes, the ATO realized there was massive tax leakage happening. You had local clubs morphing into massive commercial venues, running bars and poker machines, effectively operating as shadow businesses while still hiding behind an unverified, self-assessed tax exemption.
So the ATO finally stepped in. The brief points out a massive shift here. Since the 2023-24 income year, if you are a non-charitable NFP with an active ABN, the free ride of silence is over. You must lodge an annual NFP self-review return directly with the ATO.
Yes, and it forces the board to actually sit down, review their main purpose, check their governing documents, and legally declare that they still meet the criteria for income tax exemption. If you are the volunteer treasurer for your kid's footy club listening to this, you can no longer just shove the shoebox under the bed.
Right.
Because if you fail to lodge that return, the ATO will strip your exemption and treat the club as a taxable entity.
And when that treasurer is doing the books, there is a fascinating legal mechanism they have to understand called the mutuality principle. I've always heard it explained as having two jars for your organization's cash.
That's two jars. Yeah, that's a great way to look at it.
Right. So jar A is member money, the membership subscriptions, the annual levies. Jar B is stranger money, like when you hire out the club rooms for a non-member's wedding. Jar A is tax-free, Jar B is taxable. But why exactly is that?
Well, the legal logic of mutuality is actually very elegant. The core concept is that a person cannot derive income from themselves. If 10 people put $100 each into a pot to buy shared sporting equipment, they haven't earned $1,000 of income. They've just pooled their own money for a mutual purpose. The ATO recognizes this. So receipts from members contributing to the mutual purpose are not assessable.
But the moment you bring in a stranger, someone renting the hall who has no mutual interest in the club, that is a commercial transaction.
Exactly. And the structural failure happens when a club's accounting software just mashes Jar A and Jar B into one single account. If you cannot cleanly separate mutual receipts from non-mutual commercial income in your chart of accounts, you simply cannot defend your tax position to the ATO.
Okay, so we've solved the problem of the money coming in, but money has to go out to run the mission. And the moment you hand money to a human being in exchange for their labor, the ATO steps aggressively back into the room. Because being exempt from income tax does not exempt you from being an employer.
Oh, this is where the training wheels completely fall off. There is a dangerous misconception that because an NFP is doing, good work, the government will just go easy on their employment obligations.
Yet they don't.
They do not. You have to handle PAYG withholding. You have to utilize single-touch payroll, which means reporting tax and super information to the ATO in real time on every single pay run. You need workers' compensation.
And state payroll taxes, which vary wildly depending on whether you're in New South Wales or Victoria, and they require active applications for exemptions. But the brief really flags superannuation as the heaviest burden.
Yeah, the superannuation guarantee hits 12% from the 1st of July 2025. And the brutal reality of superannuation law is that late payments are strictly non-deductible.
Oh.
If a volunteer treasurer is busy with their day job and pushes the button on the quarterly super run 2 days late, the penalties are severe, unforgiving, and they apply regardless of your NFP status.
Come on, play devil's advocate with me here for a second. Surely the ATO isn't going to bankrupt a local soup kitchen over misclassifying a part-time delivery driver as an independent contractor. Or, paying a volunteer a little too much.
They absolutely will, because employment law does not care about your charitable heart. The employee versus contractor distinction is an area of massive exposure. If the board decides to treat the lighting guy for the local theater group as a contractor, just to save on admin, but the ATO looks at his set hours and control of work and deems him an employee.
Which happens a lot.
All the time. And suddenly the NFP is liable for years of back-paid superannuation, PAYG withholding, and penalties.
And what about volunteers? Because groups love to give volunteers honorariums to say thank you.
A genuine volunteer is someone who does not expect financial reward. The moment you start giving a volunteer a regular substantial honorarium or stipend that looks like a wage, you risk them being legally reclassified as an employee.
Wow.
And suddenly all those STP and superannuation obligations we just talked about, they trigger retroactively.
It is genuinely terrifying when you realize how high the stakes are. I mean, you would assume that with these massive employer obligations, the separate doors for tax concessions, the strict rules on mutuality, that NFPs would be incredibly cautious and static. Yet, the Trinity accounting brief reveals that the biggest risk factor isn't fraud. It isn't malicious intent. The biggest threat to compliance is simply organizational growth.
It's the ultimate paradox.
Yeah.
Growth is the silent killer of compliance. An organization gets better at its mission, it expands its reach, it tries to become financially sustainable, and in doing so, it organically outgrows its original tax framework without a single person noticing until it's too late.
The brief outlines 5 of these silent killers, and I think we need to slow down here because these are so incredibly common. The first one is commercial activity drift. Imagine a homelessness charity decides they want to provide job training, so they open a social enterprise cafe. Brilliant mission-driven idea, right?
It is a great idea, but suddenly you are generating unrelated commercial income. You are selling lattes to the general public. The ATO is going to look at that and ask, is your primary purpose still charitable, or are you now primarily operating a commercial cafe?
Because the lattes have nothing to do with the original charity mandate.
Right. And if that commercial activity scales too fast, it can literally jeopardize the core exempt status of the entire charity. It must be rigorously assessed, not just assumed to be fine because the profits go back to a good cause.
The second killer is the silent GST line. We talked about that $150,000 threshold earlier.
That line gets crossed by accident all the time. A small arts group lands a massive one-off state government grant to build a new stage. Or they run an incredibly successful fundraising gala. Overnight, their turnover spikes above $150,000.
And if they don't notice.
If the board doesn't realize it and fails to register for GST within 21 days, they're technically liable for GST on their income going forward, even if they never collected it from their patrons. It can entirely cripple their cash flow.
Okay, then there is DGR scope creep. We established that the hazmat license to give out tax deductions is heavily guarded.
And it is almost always tied to very specific funds or purposes. Let's say a charity gets DGR endorsements specifically for a school building fund.
Yeah.
People donate, they get their tax deductions, the fund swells. But then the charity hits a cash flow crisis and decides to dip into that building fund to pay the CEO's general operational salary.
Oh, no.
Yeah, that is a severe breach. You are using tax-deductible dollars outside of their legally endorsed scope.
The fourth one is governing document drift. Now, this feels like the most avoidable trap.
It is entirely avoidable, yet incredibly common. The Constitution that a lawyer drafted for you in 1995, which secured your initial tax status, probably doesn't reflect the complex digital services or broader advocacy your charity actually delivers today. If your mission has evolved, your legal foundation must be updated to match. Otherwise, your ACNC registration rests on a complete fiction.
And the final silent killer is related party and private benefit risk. Let's give a really clear hypothetical here. You have a close-knit community NFP. The church hall needs the plumbing replaced. The board president happens to own a major plumbing company and says, "Don't worry, my guys will do it."
That scenario happens every single day. And paying a board member's company isn't automatically illegal, but the mechanics of how you do it matter immensely. It must be conducted completely at arm's length.
Meaning proper quotes, proper invoices.
Yes. The board president must declare their conflict of interest and step out of the room during the vote. The pricing must be market rate or discounted, consistent with the not-for-profit character. If the ATO looks at the books and sees the charity paying a premium to enrich a board member's private business, the entire tax-exempt structure collapses because it violates that core non-distribution rule we started with.
So if you are a volunteer board member, a teacher, a nurse, a retired engineer, someone who just wants to help their community, not spend their weekends reading tax law, how do you actually manage all of this? The Trinity accounting practice outlines a very practical remedy. You have to turn compliance into a strict, non-negotiable calendar.
It is the only way to systematically de-risk the operation. You stop treating compliance as an ad hoc emergency. You map it out. Each BAS period, you lodge the activity statement for GST and PAYG withholding. Every single pay run, without fail, you finalize the STP reporting. Each quarter, superannuation is paid before the due date. You build this administrative rhythm so it literally becomes muscle memory.
But there is one item on this calendar that represents an absolute existential threat for registered charities specifically. The ACNC Annual Information Statement, or the AIF.
Yeah, that's the big one. It is generally due 6 months after the organization's reporting period ends. And this shows exactly how a simple failure of administrative housekeeping can destroy an organization. If a registered charity fails to lodge this statement 2 years in a row, the ACNC can, and routinely does, move to revoke their charity registration entirely.
And because the ACNC registration is the gateway to everything else?
The dominoes immediately fall. Revocation of charity registration cascades into an automatic loss of every tax concession from the ATO. You lose your income tax exemption, your FBT concessions disappear, meaning your staff take a massive pay cut. You lose your DGR status, so donors can no longer get tax deductions.
The organization is functionally destroyed.
Yes. Not because of fraud, but because someone forgot to file an annual form.
It brings this entire deep dive back to the ultimate lesson for you, the listener. Whether you're advising an NFP or serving on a board, the core takeaway from the brief is this. Substantiation is everything. The ATO does not hand you a permanent lifetime certificate when you start out. You claim a tax position, and you must be able to prove it with evidence on demand.
You need a single, constantly updated register of truth for the organization's tax status. What is your ACNC registration status? On what exact legal basis are you claiming your income tax exemption? What is your exact FBT status? Do you have DGR endorsements, and what is their precise legal scope? Put it in one document, review it annually, and whenever the organization tries something new, like opening that cafe, get a professional to review the structural impact.
Which perfectly synthesizes the core philosophy of this whole framework. NFP tax compliance isn't about figuring out how to pay more tax. Done right, these organizations legally pay very little tax, which is exactly how the system is designed to support them. It is entirely about defending your right to pay little tax.
The concessions are incredibly generous, but they are highly conditional. And unfortunately, those conditions, maintaining an updated constitution, cleanly separating mutual and non-mutual income, filing the annual returns on time, are exactly the unglamorous things that a busy, passionate, mission-driven board tends to deprioritize. The goal is to build the framework once, calendar the obligations, and turn it into background hygiene so the organization can finally focus entirely on its actual mission.
Background hygiene. That is the perfect way to look at it, because without that hygiene, the mission itself is constantly in jeopardy. Which leaves us with a pretty lingering thought to mull over based on everything we've unpacked today. If these incredibly powerful NFP tax concessions rely entirely on a fragile web of continuous self-assessment, complex labor laws, and strict calendar compliance, all managed by well-meaning volunteer boards, well, how many of the beloved community pillars around you right now, the theater groups, the sports clubs, the local charities, are secretly just one unlodged form, or one surprisingly successful local bake sale, away from losing their entire operating model?